Are you looking to invest in real estate, but you can't afford the insanely high prices of the Canadian housing market? Well, then you should maybe take a look at REIT ETFs, otherwise known as Real Estate Investment Trust Exchange Traded Funds. In this video, I'm going to go over my top 5 picks for the top 5 REIT ETFs in Canada. Hey, what's going on? It's Chris here from Wealth Awesome. So ETFs continue to be a very popular investment choice for Canadians, and they've claimed a decent portion of the market alongside mutual funds. As of July 2020, about 811 ETFs are available to Canadian investors. I love ETFs for their ease of trading, diversification, and low fees. But if you're more into tangible assets like real estate but can't enter the market due to the high costs, REIT ETFs offer a fantastic middle ground. An ETF is a diversified portfolio of REITs, each with its own real estate portfolio. Make sure you stick around till after the list is finished because I'll go over what my thoughts are on investing with REIT ETFs and if they're worth it or not. And if you get lost and want to learn more, I go way more in depth in this topic on my blog. Check out the written article on wealthawesome.com. So here we go with the list. I'll tell you first before I start how I rank these ETFs. I rank them based on their capital growth potential, which is based on the 5-year growth and current dividend yield. Also, the dividend yield will be stated in this format of current distribution yield and also the 12-month trailing yield. So first up, we have CI First Asset Canadian REIT ETF with the ticker of RIT. So this fund's main exposure is residential and commercial and mostly Canadian equities, with 30% into foreign securities. This CI ETF was created in November 2004 under the company First Asset, which was later acquired by CI Financial. Now CI Financial owned and managed this Canadian REIT ETF worth over $500 million in assets under management. The ETF is low to medium risk, but be aware that there still can be high market movements. The ETF fell by almost 40% in valuation in 2020 due to the COVID pandemic and is recovering very slowly, but these obviously are very extreme circumstances. From a diversification point of view, the fund looks quite evenly distributed. The bulk of the fund is dominated by residential at 32.2%, industrials at 21.2%, and retail at 18.5%. The rest of about 28% is divided into 5 different sectors. There are a total of 36 securities packed into the fund, top 5 of which are Canadian apartment properties, InterRent, Granite, Dream Industrial, and Killam Apartment REITs. They make up almost 23% of the portfolio, weighing in at around 4.9% each. It's a fine collection as 3 out of 5 are different aristocrats and 4 of them are decent growth stocks. The growth potential of its underlying securities is evident in the ETF's capital growth. It grew its share price by almost 51% in the past 5 years, resulting in a CAGR of almost 8.5%. The current dividend yield of 5.2% is also very desirable. It pays monthly dividends, but you can choose to get them reinvested back in the fund if you so choose. The combined growth potential and dividends from this ETF make it almost worth the relatively expensive management fee and MER ratio. It is currently trading at a lower than usual price since it had trouble recovering from the market crash. A housing bubble burst can really damage this fund's performance since almost 1/3 of it is based upon residential securities. Next up, number 2 pick is the BMO Equal Weighted REITs Index ETF, and it trades under the ticker ZRE. This one is mainly exposed to residential and the rest is commercial, and it's all Canadian equities. So here's another high income ETF created and managed by the Bank of Montreal's Global Asset Management team. BMO is one of the big 5 banks in Canada, as you probably know. The fund is almost equally weighted out to minimize risk, and it has been around for 10 years. It's currently rated as a medium risk. The fund is 99.6% securities and the rest is cash, so there is no diversification from an asset class perspective. There is also no geographic diversification other than whatever geographic distribution the underlying REIT has. The sector division is relatively neater. Residential and retail REITs hold the most significant portion at 24.7% and 24.6% respectively, whereas the 3rd largest chunk is industrial REITs at 20.7%. The rest is distributed among diversified REITs, office, and healthcare REITs. Its top 5 is a bit different from the earlier ETF. Granite is in both of them, but the rest are different. The underlying securities of this fund also tend to favor growth as well as dividends. It offers a 5-year CAGR of 7.4% and a respectable 5% yield. Up next is the third pick, iShares S&P TSX Capped REIT Index ETF, and it trades under the ticker XRE. This main exposure has 29% residential and the rest is commercial, and it's all Canadian equities. This ETF was created on October 2002, and apart from being one of the oldest REIT ETFs in the country, it's also one of the most sizable ones. The ETF was created and is managed by BlackRock, which is a global investment management firm. It's the world's largest provider of ETFs. It has shown amazing growth since its inception and has only two significant drops in its history. One was during the last recession and the current fall in valuation that the fund still has not recovered from. Unlike the two ETFs before, iShares' most massively populated sector is retail, which makes up around 30% of the fund, followed closely by 29% residential REITs. The rest of the 30% is dominated by industrial at 17%, followed by office and diversified REITs at 10% each. The securities are also not very equally distributed. The top 5 securities make up almost 50% of the fund. The lead holding is Canadian Apartment REIT at 15.5%, and the other 4 are RioCan, Allied Properties, Granite, and Choice Property REITs. Apart from sporting a generous dividend yield, the fund has also shown a decent bit of growth in the past. It's almost on par with the first 2 ETFs when it comes to increasing its price. The fee is reasonable enough, and if you invest a substantial amount in this fund, you can start a passive income just through dividends, or you can reinvest those dividends and leverage the capital growth. The number 4 pick is the Vanguard FTSE Canada Capped REIT Index ETF. This trades as a ticker VRE. And its main exposure is 23% residential and the rest is commercial, and they're all Canadian equities. Vanguard is the largest mutual fund provider around the globe and the second largest ETF provider. Though its AUM is paltry compared to some other funds on this list, its yield is almost on par. It tracks the progress of the TSE Canada All Cap Real Estate Capped 25% Index. The fund mostly comprises of a total of 16 medium to small market cap REITs, and industrial REITs dominate with 27.5%, followed by residential at 23%, services at 15.6%, and finally retail at 14.8%. The top 5 companies make up almost half of this portfolio in this fund as well, led by Canadian Apartment REIT at 16.4%, First Service at 11.13%, and Allied, RioCan, and Granite, which is almost 10% each. Apart from a few, most stocks are growth oriented but owing mostly to the current fall in the value of underlying securities and the sector's weakness as a whole. The 5-year CAGR comes out to 4.5%. Vanguard is the benchmark when it comes to mutual funds, but it's not wise to assume that the same would happen with its ETFs. Still, this ETF shows promise and might fare very well in the post-recession recovery. Number 5 is Purpose Real Estate Income ETF, and this trades under PHR. The main exposure is 1/3 residential and the rest is commercial. 50% is in the US and 44.7% is Canadian securities. This is a pretty tiny ETF, and it really has 2 main things that are going for it. One is its geographic diversification, and the other is its relatively decent yield. Not compared to other ETFs on this list, but comparable with other Canadian REIT ETFs available. It also has a decent cash portion, almost 5.23%. The ETF was created by Purpose Investments in 2014. The ETF has 50 underlying holdings, and residential REITs have the heaviest weight in this by quite a margin. It's weighted 31% to residential REITs and followed by 22% industrial and 19% specialized. The rest is primarily retail, healthcare, and office. The portfolio weight is pretty evenly distributed, and 3 of the top 5 holdings are Canadian. And similar names you'll see here: Granite, Smart Centers, and Killam REITs. It offers a drip plan or monthly dividends, whichever you want to choose, and like all other ETFs on this list, it's eligible for your registered accounts. Its growth history, while not on par with others, is considerable, especially in the past 3 years before the crash. As the underlying securities of the fund recover, the chances are that its growth as well as its dividends are likely to increase. But if it's offering a yield of 3.93% at its current valuation, the chances are that it would go down when the price of the fund picks up some pace. So how to buy REIT ETFs in Canada? There are a lot of different ways to buy REIT ETFs in Canada, but the cheapest way is by using a trading platform, otherwise known as a discount broker. I like to use the discount broker Questrade for stock and ETF trading, or Wealthsimple Trade is also very excellent as well if you're just sticking to Canadian ETFs. Link in the description for 50 free stock trades for Quest Trade and $10 sign up bonus for Wealthsimple Trade. So if you're interested, check that out in the description. So choosing the best REIT ETF in Canada might not be as hard as choosing the best individual REIT and will offer you more portfolio diversification. And the real estate sector is currently struggling to recover, which means that it might be a good time to buy a REIT ETF as the prices have been depressed a bit. You can get a bargain price and lock in a decent yield. My thoughts overall on REIT ETFs, they're a bit hard for me to gauge. I think that overall, the MERs are just a little too high for what I would recommend. If you purchase a REIT by itself, it's already pretty well diversified. If you purchase, say, several different REITs versus an ETF, I feel like you'll still get a lot of diversification and you wouldn't have to pay this high management fee. So I don't really favor REIT ETFs too much, but if you insist, then check it out. I think all the top 5 ones here are a great choice and you can't go wrong, I think, with any of them. All right, guys, so since you made it this far, make sure you like and subscribe to the channel. I'll be putting out new content every week. Also, make sure to check out the blog. I go into this topic in way more detail and I have a lot more articles about REITs and ETFs and stocks. So check it out. It's wealthawesome.com. I put a link in the description below. And as always, thanks for listening.